Welcome back, Property Navigators. Today we delve into the age-old buy and hold strategy, a classic method in property investment. Now, this strategy has stood the test of time. So let's take a look at how it has been used and compare that to today's market landscape, then reframe some of its fundamentals. Traditionally, at its very core, the buy and hold strategy is just that. You buy a property and you hold on to it. Now, this strategy has been a potent tool for wealth creation over past decades, and is a journey almost every successful property investor has navigated. Let's check out this by looking at CoreLogic's last 30 years of Australian property price data. You can clearly see that over Australia's past 30 years, property prices have increased. There's been 6 peaks and 6 dips, but overall everything has gone up. It can't be missed. Looking further into the data, houses across our capitals have risen by 453% in 30 years and by 313% in our regions. Now, we know units don't perform as well as houses, but there's still some massive gains over the 30 years of 306% and 200% respectively. So we can clearly see that buying and holding for the long term works. The advantages of buy and hold lies in its low risk profile and high rewards, chiefly through a very important concept that you need to understand called compounding capital growth. Now, I'll explain this for you. Over the long term, property values climb, and this is called capital growth. It's the difference between a property's purchase price and the current market price. Capital growth is powerful because it compounds each year. But what does this mean? Simply put, compounding growth means if a property is purchased at, say, $600,000 and it increases in value at 5% per year, it is growing at 5% on the new value of the property each year, not 5% each year on the initial $600,000 value. The main attribute of building wealth using compounding growth is time, and I can show you this in the table on screen. You can see in this example that during the first 5 years, the property value only grows by $165,769, whereas in years 10 to 15, the property value grows by $270,000. And look at how much it is growing per year in the first few years compared to year 15. It's almost double, and that's per year growth. Albert Einstein said that compounding growth is the 8th wonder of the world, and he wasn't lying. Over time, a property's future growth builds on its previous growth, creating a snowball money-making machine. But remember, traditionally growth is slower at the start, but as you can see, it really ramps up the longer you hold the property. So you do need to be in it for the long haul. Traditionally speaking, the buy and hold strategy sees an investor hold on to the right property with an aim of not selling for a minimum of 15 plus years. The longer the better, and for many, traditionally it's been 20 or 25 plus years. This is so the maximum benefit of compounding capital growth is put into an investor's pocket. Just look at the difference between selling in year 7 versus selling at year 15. You'll see that growth certainly isn't linear. It's more exponential in nature. This kind of growth is called market growth, growth that is organic and reliant on the market steadily increasing, as we saw earlier in CoreLogic's 30 years of price growth. So in past decades, a lot of investors have been able to literally just buy and hold their investment properties. With a bit of maintenance, properties just sat there for 20 or 30 years and did their job, increasing in value. The difference these days is the path of achieving success using the buy and hold just isn't as simple as it once was. The market has grown more complex, and the strategies that once worked like clockwork now need a more nuanced approach. So while the buy and hold strategy remains as a cornerstone of property investment, it's essential for today's investors to be more astute, curious, and adaptable. Enter the buy and hold 2.0. The Australian property market has constantly evolved over the past decades, bringing new challenges for investors, especially those just starting out. We've seen unprecedented once-in-a-lifetime price surges in just the past few years, and PropTrack's Housing Affordability Index shows that affordability is the lowest it's ever been. Properties in past decades were bought for $200,000, $300,000, $400,000 or less, which just isn't the case these days. Well, for the most part, the markets for these budgets are really becoming rarer to find. The buy and hold was definitely a great journey if you started out back then. But now in 2024, because prices are so high, the amount of movement these properties have just won't be as effortless as going from $200,000 to $1 million like back then. So we need to adapt. Now, the whole concept of wealth creation through using buy and hold isn't just about accumulating assets. It's about building a substantial capital base to work from and then using this capital base to produce a steady stream of income to recycle into more properties to build wealth and produce that passive income. Now, here's a 3-stage framework you can layer over the buy and hold called the stages of investing. The 3 stages are the accumulation, consolidation, and debt reduction stages. Now, it's important to note that these stages aren't linear. And as I'll show you, you're able to move in and out of each stage fluidly. But firstly, I'll explain each stage in isolation. The accumulation stage. So in the accumulation stage, you are essentially growing your portfolio of properties. You'll need to start with your savings to buy your first property, and from there, use built-up equity for purchasing subsequent investment properties. This is called leverage, using equity from one asset to invest in another. Here in the accumulation stage, you want to be really thinking about 2 concepts: timing the market and time in the market. They sound similar, but are very different, so point those ears my way. Firstly, timing the market simply means when you actually buy the property. So making sure you are buying into a market at the right time in its cycle. It's not just about where you invest, but when. For example, buying into a market before or at the start of a growth cycle means you will achieve the best short-term capital gains. Market cycles look like what is on screen right now, and it's important to buy before prices peak so you attain the highest return on your investment. Obviously, you can see on screen that you really want to be buying at this point of the cycle here before prices have risen, and not here when prices have already peaked. Now, if you time your purchase right, you should get a return on all invested capital within years 1 to 3, so the equity can be extracted and leveraged to invest into the next property. We have coined this term the 3-year rule here at Property Navigation. Secondly, time in the market is exactly that. How much time you hold the property in your portfolio to achieve compounding capital growth. The longer you are in the market holding your property, the more its value compounds over time. If you get both of these factors right, you'll be able to accumulate more properties sooner, giving you more overall time in the market with your portfolio providing more capital growth and equity in the long run. The consolidation stage. In the consolidation stage, you'll be focusing on increasing the value of your properties. This value add could be through cosmetic renovation, adding rooms, or it might be increasing cash flows by splitting a property into dual occupancy or putting a granny flat on the back. Whichever way you go about it, you are ultimately raising the value of your properties. This is called manufactured growth, when you value add to increase the market price of the properties in the portfolio. The next stage is the debt reduction stage. The debt reduction stage is where cash flows are directed to pay down debt. This is very particular to each investor's portfolio and circumstances, but the idea is to lower and get rid of the majority of overall debt, with the first to go being any non-taxable debt, such as principal place of residence. This might look like selling some properties to pay off others or using cash flows to pay down loans. So you end up owning however many properties it is, but you own them outright. There's no more banks involved or anything like that. You essentially then have your wealth base and your generated income to live from. Now let me explain how you can go between these stages throughout your property journey by using an example. Let's say we purchase a quality foundational property early in its market cycle and see some good capital gains, average of about 15% per year for 3 years. Over these 3 years, we add value to this property by doing cosmetic renovations like painting, upgrading the kitchen and the bathrooms. We then maximize the equity we can leverage for investment into our next property. We know by spending X amount, we actually increase the property value by X amount, and this also increases our rental yield. We then simply hold the property for another few years, and after that, when equity rises again, we might even add a granny flat to really boost our yields by another 10%, giving us more cash flow. This exercise effectively moves us back and forth between the accumulation and consolidation stages. Once your portfolio has some quality foundational properties doing the heavy lifting for you, like our last example here, let's beef this example up a bit and take it a bit further by moving fluidly between all 3 stages. Let's use another example. So you bought your property and nailed the location and got in at a great time in its market cycle. You've been able to add value to it over a 4-year period that achieved about 17% capital growth per year. So you've achieved 68% growth in 4 years, and the market's peaked and it's topped out. So instead of traditionally just sitting on this property for another 15 years, you may decide that it's better for your portfolio if you sell the property before prices drop and reinvest into better opportunities. This is, you guessed it, the debt reduction stage. You could then use the remaining cash and portfolio equity to purchase 2 less expensive properties earlier in their market cycle, ultimately entering the accumulation stage again. Key considerations. First up, let's tackle the concept of leveraging the buy and hold method in today's market. This strategy is about more than just buying. It's about holding with purpose and foresight. It's about making your first, second, and third property a stepping stone to your next, aligning each purchase with the bigger picture of your investment journey. No longer is it a linear approach, but a much more dynamic, active, and moving framework when laid with strategies that are more aligned to today's market. Now, long-term planning might sound daunting when you're just starting, but here's the thing. Even though that initial purchase is crucial in its own right, it's equally important to think about how it fits into your future portfolio and investment strategy, so you can move on to your second, third property, and so on. You need to be looking at buying properties that you can add value to, either by cosmetic renovations or dual living. You want to be making sure that you are maximizing your block sizes and buying nice big blocks where you can. This will keep your options open for subdividing or development later on, sometimes many years down the track. With this in mind, always check your zoning as well. Understanding equity growth is key. The value increases in your first, second, and third properties are a powerful tool for future investments. It's about the increased value of your first property to finance your next, creating a chain of growth-driven investments. Reinvesting your cash flow is another essential consideration. This might seem like a distant future, but it's important to plan, whether it's using rental income to pay down your mortgage faster or saving it for a down payment on your next property. Smart cash flow management is key to growing your portfolio. The significance of time in the market can't be overstated. Property investment is a long-term game. Your first property is just the beginning. Over time, natural market growth can work in your favour, turning your initial investment into a cornerstone of your financial future. Lifestyle choices and financial goals should drive your investment strategy. Think about what you want in the long term. Are you looking for financial security, passive income, or perhaps an early retirement? Let these goals shape your investment decisions. Now, for those who feel like they're getting a late start, remember, it's never too late to begin. Your strategy might differ from someone who started in their 20s, but the property market offers opportunities at every life stage. If you'd like more personalised information, we do offer a free 1-hour consultation. Our phone number's in the description. And lastly, embrace an holistic approach to investing, balancing capital growth, cash flow, and your long-term goals. Until next time, happy property navigating.